India's trade deficit narrowed in June as a slowing economy and lower oil prices curbed the import bill. But exports fell as much as the imports last month. This indicates the magnitude of the task for the government, which seeks to promote greater exports even as domestic industry shows little sign of revival. Weak global growth and Trump's demand on India to reduce trade surplus with the US are only going to cause further hiccups. So will it be wise for India to look inward rather than outward in a situation like this? Let's put that question to Chief Economist at Crisil, DK Joshi. We also need to talk to him about the other macro indicators that came out, both local and global. Mr. Joshi, good having you. Thanks so much for joining in. Normally, we would cheer the fall in trade deficit. This time around, it seems to be caused by a problem which could plague India for the near term, which is that growth is under a big question mark.
Well, I think there are two sets of factors playing out. I think globally, because the world economy is slowing, so the pie available to you for exports is shrinking. So you need to work harder to get more of that shrinking pie. And I think looks like in the labor-intensive segments like gems and textiles particularly, we are not doing that well. I think that's what the June data shows. And then I think there is one-off factor like fall in oil prices, reducing your export bill as well as your import bill. But I think overall, apart from that, I think there's another important factor that is having an impact on the trade deficit is this weakness in the economy. So when the growth is weak, you import less, and I think that is getting reflected in data as well. So it's a combination of global and domestic factors which have brought the trade deficit down, and particularly I think important is that the export growth has turned negative. I think it's been minus 9.7%, which is actually much weaker than what has been experienced in other economies. So that directionally it is correct, but I think the impact that India has seen is much stronger.
Okay, so the exports growth is looking weak. Mr. Joshi, the question then that comes to mind is that lower crude prices definitely helped curb the import bill. If indeed, due to tensions between US and Iran or otherwise, if crude prices were to inch up, that would quickly put this shade better trade deficit into question mark again in the months to come.
Yeah, precisely. I mean, so because we are so much oil dependent and our imports of oil always exceed the exports of petroleum products. So clearly, I think oil prices going up in that sense expands our trade deficit as well as our current account deficit. And if oil prices were to reverse course, I think then that will become a worry.
Okay. What did you make of the other macro data? And, I also want a question on the Chinese data that came out, but before that, what did you make of the other macro data? We've had WPI, CPI coming in, not that they gave any surprise, and I believe all of that points towards giving enough ammo to the Reserve Bank of India to be more accommodative. What did you make of that data?
Yeah, absolutely. I mean, the growth is weak and so is inflation. So, and I think inflation, particularly WPI, has again fallen. I think it's to do with commodities there. But the key message there is that there is more room for the monetary authorities to ease in interest rates, and I think the global factors also support easing of monetary policy in India because the most of the central banks have turned dovish, and the US is expected to cut rates this year itself. So in this scenario, I think we should see more rate cuts happening. I think, but the critical question at this juncture is not how much the RBI is cutting, but how much of it is getting transmitted into the system. So this is getting reflected in the deposit rates and in the lending rates in a very weak manner. So I think the transmission is quite anemic at this juncture.
Okay. One word, Mr. Joshi, on what do you make of the global data points as well? China's GDP growth numbers, since they've started reporting this in this format that it is, clearly throws some indication of inward-looking growth. What would that do to maybe global growth? Because I think global growth and global demand will be a big factor of what happens to crude and the yields across the world as well.
Yeah, I think there is clearly the tilt of the risk is to the downside, whether it is China or it is United States or it is Europe. So particularly the Europe and US are still above their long-term trend rate of growth. So they will naturally move towards their long-term trend. And I think the China is I think doesn't have enough ammunition to fire its growth on its own. I mean, so maintaining around 6.2% is what we expect. I think for 2019 for China, which is slower than what it has experienced in the past, but that's the new reality.
Okay. One last question, Mr. Joshi. Anything in the Fed commentary that will come up soon, or the policy that will come up, which could have a bearing on your view on how the macros are shaping up as well? Because I think what flows do as a result of policy rates in the US and Europe might be a big factor of what happens to currency and yields back in India as well.
Yeah, I think the global environment has been a mixed blessing. As we talked, the slowing of the world economy means less opportunity to export, but it also means the easier monetary policies in advanced countries, which I think which opens up channels for money coming into emerging markets, and India has been a beneficiary of that. I think if you scan over the last couple of months, I think the rupee has been appreciating, the foreign capital inflow has been strong, and I think that's permitted by softer monetary policy in the advanced countries. So I think a further rate cut would, I think it's already priced in by the markets, but nevertheless, I think as and when it happens, I think that will improve conditions for more capital to flow into India.